Right now, if you are renting in Seattle, you probably feel like you've won. You can get concessions everywhere, get like 6 weeks worth of free rent just for signing a lease. But I'm here to tell you that the party into 2026 is probably over. The Seattle metro rental market is sitting in an air pocket right now where things feel safe, but we're flying right directly into a supply cliff here in 2026. And this is where everything changes. You see, most people think that high interest rates killed the rental market, but they are wrong. What it's actually done is it's created one of the biggest opportunities to buy in the last decade. And this is due to a series of factors that we're going to get into in this video, from rent control to lack of supply. I'm Anton Stetner. I've been selling real estate here in the Seattle metro since 2003. We've closed thousands of transactions. We do brokerages, we do investments, we do land development. And I made this video so I could give you the data on what we see coming in 2026. This is for the renter who asked for it in the comments. We want to reply to your comments, so always ask them below. This is for our investors who asked the question, where are we going in 2026? And this is for the first-time homebuyer who's considering, should I purchase in 2026 or should I keep renting? The supply cliff shows up in the hardcore data that I'm always reading and investigating for you. In 2025, we've seen permits down 66% in the first half of 2025 here in the Seattle metro. The metro-wide units fell from 15,000 units in 2022 to 5,000 units in 2025. When I'm talking about this unit count, I'm talking about the construction starts. I need you to understand that to build multifamily, these large complexes, it takes 2 to 3 years. That means if it wasn't started in 2023 or 2024, they don't open until 2026. But what happened in 2022? In 2022, the Federal Reserve massively hiked interest rates, the largest since the 1980s. And that's when we saw these new construction land development projects just grind to a halt. I'd like you to think about this real simple. We pinched off the supply, and it's simple math. No new buildings plus consistent demand equals a price squeeze or prices going up. The insider stats that people are looking at right now is everyone's looking at the 7 to 8% vacancy rates. But by 2026, what has actually happened is we expect those to drop to around 5% because that spigot of supply has been pinched off. And you're seeing this happening. Just simply look around the Seattle metro. How many more new apartment complexes and townhomes are being built? We are currently building less. And I need you to understand that that is only half of the supply problem. The other half involves a company called Amazon and what Washington State did as a mandate that they forced into law that changed the rules of renting here in Washington State forever. I'm your super nerd. I like to go read about these things, dig through all these industry reports, look at the charts, look at the data so that you can stay ahead of the market here in the Seattle metro and then not get crushed or not miss out on the next opportunity. So hit that subscribe button if you want to track this data on a regular basis and know before the mainstream media what's actually happening here on the ground. What we've already started to see in 2025, which I believe this trend is going to continue in 2026, is the donut effect reversal. So I call Seattle and Bellevue the centers of our real estate universe. And every ring you go out from there is just one further ring in the donut. But essentially, those donuts right now are collapsing, and people are having to move back into the city, back into the metro, because of the renter lifestyle and Amazon's mandated 5-day return to office. What that means is one of the largest employers in the area is pulling people back into the urban core. And these specific tech workers, and it's not just Amazon, they earn 40 to 60% above the median income. They want to live near the office. They want to live in the A-class building that has the amenities and the lifestyle. And this lack of affordability that all of us are experiencing here in Washington right now, and especially in the Seattle metro, is creating a buying gap. That owning a home is currently 2.65 times more expensive than renting. So the average around $6,000 a month, with the average rent being around $2,247. This means a large percentage of these high income earners are stuck renting, and they essentially become sticky tenants that are there for the lifestyle. which creates this feedback loop. We have high demand, zero supply coming, which usually means that rents will go up and they might even moon. But Washington State just threw a wrench right into everything that happens, and it makes this opportunity a lot more complicated. And I'm talking about rent caps. I'm talking about House Bill 1217. And this becomes the use it or lose it trap for the landlord, and it also becomes a trap for the renter. The rent cap bill here in Washington State has a max of CPI plus 7%, but it can't go higher than 10%. And that means that the price for 2026 means that rents can increase by 9.68%. Now, this is like a crazy paradox. In a free market, a landlord might wait 3 years and then raise the rent all at once 15-20%. But now they can't. They're incentivized to raise rents every single year because they have to preserve their rent basis. Also, this drove out the ma and pa landlords. The ma and pa landlords, they usually don't raise their rents as fast, and we're getting left with the corporate landlords who always raise their rates because they have to appease shareholders. The government tried to protect renters, but what they have just guaranteed is that you're going to see 9%, 8%, maybe even 10% hikes forever because people are worried they won't be able to keep up with rising costs and inflation. I know this sounds bad for renters, and I do believe the next ring out right there from the Seattle Metro is actually going to be a lot easier because there'll be less demand pulling in. And of course, 2 to 3 rings out is also going to be easier. But if you're an investor who's thinking about buying their first duplex or buying a multifamily property, I want you to understand that this regulatory moat that's been created is probably one of your best friends. And I know some of you are going to say in the comments, you're going to argue with me that Washington State is no longer the place to invest. And I believe the opposite. What I see in the comments is you say crime is up, you can't evict people, too much regulation. I like to flip that over. That regulation is also creating the opportunities. It's also creating a tighter market, and that tighter market creates upward pressure on rents. And for investors looking for deals, I think right now at the end of 2025, beginning of 2026, it is still deal season while the market feels a little bit soft. And you need to get in before the net operating income, aka the NOI growth in 2026 starts to show up. I'm telling you, buy at the bottom of the sentiment cycle. As rates go down, more people will be purchasing investment properties, multifamily, and single family. Real estate is a long-term game. It's about fundamentals. And the fundamentals in our area is we still have tech jobs. We still have a growing economy. We're getting aerospace growth from Boeing. And we have a land scarcity and a land development problem in our area. As someone who's touched land development for 20 years, here's what I can tell you. All it's done is become massively more costly, massively more red tape, massive more regulation. And when we look at the cost of construction since 2020, it is up almost 50% in most areas, and some areas are even more than that. I want to hit you with a little bit of quick raw data. The projected rent growth in the Seattle Metro is between 2 to 4%. That's from a combination of apartment lists, GPS renting, and CoStar. Current rent is sitting around $2,200 for the median rent in the Metro. The vacancy rate has been on the slight decline, and we expect the vacancy rate for 2026 to be 5% or lower. The number of new permitted projects is down 66%, which is just an insane number. Like I said in the beginning, it went from 15,000 to 5,000, with construction costs being up over 50%. Couple other pieces of data. RealPage Analytics expects a 3.7% increase, and they say it's driven by stronger renter demand from population and job growth and reduced new supply as those peaks tighten vacancy rates and empowering landlords to raise prices. CoStar predicts 2.2 to 3.6% increase due to the recent absorption and drop in delivery rates. Redfin talks about a 2 to 3% increase. Zillow, very conservative. They're saying flat, almost no growth based on improved affordability and economic caution. CBRE talks about a 3% compounded annual growth rate. And like I mentioned before, I believe supply is the biggest one here. We still have people moving into the area. We still have a strong economy. And now we have that supply cliff that's hitting us from 2022. It shows up in 2026 and becomes very prevalent in 2027. And that's why we have been positioning ourselves and purchasing projects and building stuff to get ready for the increases in 2026. So in summary, the Seattle Metro is pretty simple. Supply is dead. Demand is rising and regulations are forcing rent increases. If you're looking to invest in this market and you need a strategy for 2026, my team and I are happy to have discussions with you about buying a home or buying your first investment property. Just drop the comment below buy, or feel free to look at the pinned comment for our contact information. I'm Anton Stettner. Thanks for hanging out with me and talking about rents. If there's some piece of data I missed or a question you have about the market, also feel free to drop it below and we will do our best to reply to every comment.